Hello everyone, and welcome to the Strategy of the Week for March 10th, 2017. My name is Patrick France, Instructor and Senior Consultant here at VectorVest. Well, with the market pulling back sharply this week off of its all-time highs, we feel that this is a better time than ever to cover a very important subject of locking in your gains. That's why this week's Strategy of the Week is titled Protecting Profits. So, let's get right into it. Now, a lot of you out there are probably sitting on some very nice gains that have been made in the rally that we've had since the middle of November. One of the worst things we could do is sit idly by and give those gains back to the market. So this week, we're going to go over 8 different methods of protecting the profits that you do have. Now, let's jump right into it. The first method we're going to cover is using protective stop-loss orders. Protective stop-loss orders would include percent gain loss, trailing stops, stop limits, and are one of the most common ways of protecting your profits. Dr. DeLito goes into more discussion on this subject in Chapter 10 of his book, Stock Strategies and Common Sense. One idea there is technically oriented investors may prefer to use their choice of a moving average to help them decide when to sell a stock. So, to give an example, I have taken the top VST stock, which is Momo, and adjusted the moving average to a 20-day moving average. To see how this can be done for yourself, let's jump into VectorVest 7 and take a look. So once we're into the program, as you'll notice, we'll start off in the Viewers section, and then click on the Stock Viewer on the left-hand side. As we can see, Momo is at the top of the list, so we'll right-click and go to View Stock Graph. Just maximize it here, and expand the Graph Control Panel. And as we can see, we have the price and candlesticks, a simple 40-day moving average, and below there, the RT. Now, by default, the VectorVest layout has a simple 40-day moving average, and we feel this is a great place to start. Now you'll notice, a 40-day moving average will be a little bit quicker than a 50-day moving average, which is more commonly used by the institutions. Therefore, this will get you in and out a little bit quicker than the big money. And while the 40-day moving average is a great place to start, sometimes you may have to customize the moving average to adjust it to an individual stock. For example, we have Momo here. And as we can see, Momo just shot off yesterday and is pulling away from the 40-day moving average. Now we wouldn't want to sit idly by as the price falls all the way back down and goes below that 40-day moving average. So one option we could do is tighten up that moving average to get it closer to the price. So if I come down to the lower right hand corner and click on the down arrow next to the 40-day moving average, you'll notice I tighten up the price here. Now if we put it to a 20-day moving average, you can see that the moving average is now right below the price. And every time the price has touched the 20-day moving average in this most recent uptrend, it tends to bounce right off of it and continue to move higher. So as long as price continues to rise, the 20-day moving average will catch up to that price very quickly. But one thing to keep in mind, however, is that if the price starts rolling over, so will the moving average. So use this as a guide. Now let's take a look at the next method. Method number 2 is sell covered calls. When you sell a call option while owning the stock, you are writing a covered call. If the stock price rises, you may be forced to sell the stock at the strike price, also known as being called away. If the stock's price continues to drop, you can sell the calls against the stock position over and over again. Your losses on the stock position will be at least partially offset by all the premiums you will put in your pocket. Now, if you're new to options, this is a great place to start, because with covered calls, there's very little that you can do wrong. If the stock happens to get called away from you, then you'll at least be collecting the premium and potentially some gains from the price that you entered to the strike price that you sold. If the stock does not get called away from you, then you can keep on collecting premiums as long as you continue to sell those calls. And to demonstrate that, we'll simply take a look at the risk graph of a covered call. And as we can see here, if the price pulls back moderately, the call that we sold will help offset some of the loss. But if the price falls substantially, the premium that we would have collected from the call that we sold will only offset part of that loss from the underlying stock. So now, our third option is buying put options. If you own a stock, you profit when the stock's price rises. If you own a put option, you profit if the stock price drops. So, if you buy a put option while also owning the stock, you are basically buying an insurance policy. If the stock drops, the put will rise in value, offsetting some of your loss on the stock. If the stock rises, the put will decrease in value, perhaps expiring worthless, just as an insurance policy is designed to do. Of course, you must take money out of your pocket to pay the premium for the insurance. Also, if the stock starts to rise, you can always close the insurance policy out and get back some of the premium you paid. Also, for anybody considering the two options trades that we've covered, two key things to keep in mind are: 1, do you want to take in a credit or do you want to pay a debit? And 2, selling a covered call caps the amount of capital you can receive to offset your loss, whereas buying a put option, you have unlimited profit potential if the stock continues to fall. To demonstrate that, we'll take a look at the risk graph for a put option. And as we can see, as long as the stock continues to fall, the put becomes more and more profitable, offsetting more and more of that loss from the underlying stock. And now the fourth option is to combine buying a put and selling a call, which makes a caller. A terrific way to finance your insurance policy is to do both methods 2 and 3 at the same time. This is more commonly known as the collar option. We outlined this technique in some detail in the February 12, 2016 VectorVest views. And the reason why a collar is so powerful is because you take in the premium from the call that you sold to offset the cost of the put that you bought. So now you are capping your upside potential, but also minimizing your downside loss. To demonstrate this trade, we'll take a look at the risk graph now for a collar. And just as we previously mentioned, we can see that there is a max profit potential of the trade, but also a max possible loss. So this can be a very effective way of buying some low-cost insurance on your stocks. This also makes it very easy to define your max risk. So now let's move on to the next option, buying index put options. So as we mentioned previously, buying a put is a great way of protecting your profits in your stocks. But what happens if you're diversified in multiple stocks, and then buying insurance on each individual stock can get pricey? So another option is buying a put option on the overall index. If you own many stocks in your portfolio from a particular market segment, such as the NASDAQ, you could buy QQQ put options on the index instead of each individual stock. If the index drops, the put options will increase in value as the price of the stocks are dropping. This is the same as buying a put option against your individual stocks, but you would use the index put options instead of individual puts on each stock. And to determine how many put options you should buy to protect your whole portfolio, we have come up with a nice formula. The formula would be number of contracts equals the value of the portfolio divided by 100 times the put strike price. This can be a great help in determining how much insurance you should buy on your overall portfolio. And now the sixth option is buying contra ETFs. Contra ETFs are a new investment tool that have really started picking up in popularity over the last few years. Luckily, here at VectorVest, we have several searches and watch lists located in the program, which will guide you to the funds best poised to profit when the market contracts. If you want to avoid the leverage funds, you can even find watch lists with funds that only move at a 1-to-1 ratio. Now, to find these contra ETFs, we'll jump into the VectorVest program. And as you'll notice, we're on the Viewers tab already. So we'll come down to the left-hand side, and in the watch list section, the fourth folder down is titled ETFs. If we click on the folder, that'll expand it here for us. And here you'll find 2-time leverage ETFs contra, 3-time leverage ETFs contra, and then if we keep moving down the list, since they're in alphabetical order, we have non-leveraged ETFs contra. And now, before we go any further, I just want to explain the difference between leveraged and non-leveraged. A non-leveraged ETF will move 1-to-1. As an example, we'll take the S&P 500 index. A non-leveraged contra ETF will move up 1% if the S&P 500 index moves down 1%. Now, a leveraged ETF on the S&P index, using the same example, will move up 2 or even 3% if the S&P index falls 1%. So depending on your risk tolerance should depend on what ETFs are right for you. And now that we're looking at the non-leveraged ETFs contra, if you ever have any questions on what any of these ETFs are looking at, when in doubt, right-click. If we right-click on RWM, for example, and go to View Full Stock Analysis Report, we can get a plethora of information here. If we scroll down to the business description, we'll see that this is looking at the Russell 2000. Also, we highly recommend to make sure that you're familiar with the underlying fund and not looking at ETFs that may not correlate to a specific direction of the market. So if you're new to contra ETFs, stick with ETFs on the major indices. A great place to go for that is back into the viewers, and in the watch list section, we have indexed ETFs contra. Here you will find a watch list on all the ETFs, leveraged and non-leveraged, on all the major indices: the Dow, NASDAQ, S&P, and Russell 2000. So now let's jump back into the program the slides and take a look at our 7th option. And the 7th option may be one of the most aggressive ways of protecting profits, but you can always hedge with short sales. And to keep it simple for anybody just now learning about short sales is betting that the stock is going to go down. And as we have here, another way to protect profits in an uncertain market is to sell short bad stocks while continuing to hold your long positions in good stocks. For example, you might use the Searchers Short group in VectorVest to find stocks that are likely to go down and sell them short. If the market falls, the shorts will rise in value, while offsetting the losses you might incur in your core holdings. For more information on our new and improved shorting searches, check out the VectorVest views on January 6th of 2017. And finally, the last option is to simply sell your stock outright. Close the trade. You know, as our founder, Dr. DeLito, always says, cash is always a position. Finally, the surest way to protect your unrealized stock profits is to simply sell the stock. You would then simply hold cash in your account while waiting for the market to settle down. Of course, once the stocks are sold, you would not participate in any further upside price moves. Also, unless you are selling the stocks in some sort of a tax advantage account, such as an IRA, you will owe tax on your capital gains. And folks, the only way to have a realized gain is to sell the stock outright. Until you officially close the position, all the gains you have in the stock are unrealized gains. So never be afraid to close out of a position if you're not comfortable in the market conditions. We would rather have to pay a tax on money that we've made rather than watching our hard-earned money disappear. So there's always considerations around these topics. But you must do something to protect your gains. And even though the market has been rocking and rolling over the last few months to its all-time highs, we also know what goes up must come down. Now, the one thing we don't know is how big the pullback will be. Using these types of protection will help guarantee your success in the stock market and guarantee that we're profitable, which is why we all get into the market in the first place. Well, it's been my pleasure being with you here today, and I hope that everyone can walk away with at least one new insight to help their portfolio grow. So for now, have a great weekend, and we will see you all in the VectorVest University